they're negotiating on fumes. But we'll see what happens. Maybe we have to go back and finish it. Maybe we don't. Right now, I mean, you can speak to Steve Witkoff and Jared. They're doing a good job. But right now, I think it looks like they want to just make a deal. They want to. They have. I don't think they have a choice.
Hello and welcome to the week ahead on Nomura Podcasts. I'm Dominic Bunning, head of G10 FX Strategy, coming to you from Milan, hot on the heels of our macro conference here. And today is Friday, the 29th of May. Well, the Middle East continues to dominate discussions in financial markets, with hints that negotiations between the two sides are actually progressing, albeit slowly. As you heard from President Trump there at the start of the episode, he clearly thinks the US holds the cards and Iran will make further concessions, although the flare-up in tensions over the last few days with various strikes and drone interceptions suggest there may still be some ground to cover. The latest headlines do, however, point towards a little bit more positivity. Markets are somewhat undeterred by all of this, and as we record, equities continue to push to new highs, helped by booming sentiment around the AI, chips and semiconductors trade. Oil prices have stabilized below $100 a barrel, and yields are also off their peak globally. The dollar's softened a touch, but is struggling to sell off too far given the improved optimism around the US economy. This latter point is something we're going to touch on with David Seif, our chief economist for developed markets, soon, ahead of key US labour market data next week. In Europe, we'll be looking at what survey data could shift the view for central bank pricing, and in Asia, we'll look at inflation as well as the specific challenges facing the RBI and the Indian rupee ahead of the central bank meeting there. I also want to flag that in the next couple of weeks, we'll be releasing some one-off podcasts coming live from our Nomura Investment Forum Asia event held in Singapore annually, where we have some very special guest speakers attending, so please keep your ears and eyes out for those. But for the time being, we've got plenty of topics to get onto, so let's get stuck in. Well, we're going to kick off this week in the US. We've got David Seif, our chief economist for developed markets, joining us from New York. David, thanks a lot, as always, for coming on. We're going to start off with the data this week. Labour markets always hotly anticipated, and it does seem like the underlying trends are generally improving in line with what you've been expecting for some time. What are you thinking for this Friday's release?
Hey, Dom. Well, great to be here. We are, as of this recording, we have not completely finalized our June 5th employment forecast, but we're pretty close. We're expecting a 4.3% unemployment rate, so that's unchanged, although it was a high 4.3% last time. So balance of risks on an unrounded basis is for a slight decline. When it comes to NFP, we're expecting something in the low 100s. That is still to be finalized, but something that is approximately equal to the NFP growth that we saw last month, and that really is a pretty strong number. That would bring up the average for the year, which is in the high five figures right now, and more than that. Almost certainly be above the level that is necessary in order to absorb all the new entrants into the labor force. And so that is really that would be a very robust number if that were to be realized.
Okay, brilliant. I mean, it does seem to be fitting the current theme that a lot of the US data is coming in pretty strong, whether it's investment numbers, whether it's capex type themes, whether it's inflation data in general. It does seem that the Fed in particular has become a little bit more hawkish in a lot of its commentary recently in line with that. I know you guys changed your Fed view just last week, and we discussed that on the podcast with Jeremy, I think. But the question I want to ask around that is, how far away are we from starting to think about Fed rate hikes? How strong does the data need to get before people start to think the next move from the Fed could actually be higher rates?
Yeah, so we did indeed change our Fed call. We now expect the Fed to remain on hold indefinitely through the end of 2027, at least, which is the extent of our forecast horizon. And I think there are a number of things to put number of items to speak about with that, which will include addressing your specific question. The first is that we still certainly see Warsh as more dovish than probably any of the other 18 people on the FOMC at this point. But what we really have seen is that in part due to circumstances and in part just due to how vocal other members of the FOMC have been, there clearly just do not seem to be 7 votes among FOMC voters in order to cut rates. And in fact, it doesn't seem like there's anything close to it, although it wouldn't shock me if Warsh ultimately does want to do that. But we just don't see him being able to do that. So he comes in because of how much bonds have sold off, because of the inflationary effects of the Iran war and other inflation outside of it that we've been seeing. He comes in really having to play defense, I think, prevent hikes rather than being in a position to push for cuts. And we ultimately think he'll be successful at preventing hikes. But I do think that there's a real risk of hikes, even though that's far from our base case. I would say a little bit off the cuff that maybe there's a 1 in 4 shot that the Fed hikes over the course of the next year. So certainly our view is more dovish than the market's view, which is implying that there will be a hike at some point over the next year. I think, though, that if there were to be a hike, it would need to be something that was primarily driven by others on the FOMC. And of course, there are 12 voters on the FOMC at any point. Kevin Warsh is only one of those 12 votes. And if at any time 7 FOMC voters decide that they want a hike and actually vote for it, that is the policy that would come out. Now, that would be something that is a dynamic of the board pushing for a hike or pushing for policy not being driven by the chair. That would be unique in modern Fed history. But at the same time, it is unique to have a Fed chair who we expect is pretty far away from most of the rest of the committee in his views. And so something that we do see as plausible, even though it's not our base case.
Brilliant. I mean, certainly something to watch. And as you say, sort of unprecedented to some extent in terms of how things could develop. So definitely interesting from a market perspective. To finish with another thing that's very interesting from a market perspective is clearly what's happening in Iran. I'm not going to put you on the spot and ask you, when's it all going to end? There's obviously so much back and forth. But, when you take the US perspective, do you think we are much closer to getting some kind of deal? And are there any sort of parameters or factors you're looking at locally in the US that you think might drive the US administration to really push forwards towards getting something signed?
It's a great question. And I mean, it's just been so unbelievably volatile with the news flow. To pin down for our listeners when we're recording this, it's just past 10:15 a.m. on Thursday, May 28th, Eastern time. And just as we've been recording this, we see a new set of headlines that come out, which if we were reacting just to the news flow would force me to give a different answer to this question than I would have literally 5 or 10 minutes ago. So I think that we should be very skeptical of the news flow, even if things progress, even if the Strait does reopen. It doesn't seem as though we're anywhere close to a final deal that deals with the nuclear issues, et cetera. And so I think the uncertainty around Iran in general and specifically the Strait of Hormuz is going to remain in place for some time, even though I'm sure we'll go back and forth multiple times as we have over the past 3 months or so. I think that there isn't a huge amount of pressure on Trump to forge a deal, or at least there isn't going to be much more additional pressure. We've already seen gasoline prices rise significantly in the United States, although they still are much lower here than they are in much of the rest of the world. We've seen Republican polling for the November midterm elections get hurt pretty badly. That seems unlikely to recover, almost no matter what Trump does. But if that were a major motivating factor, he really would have needed to move already. So I don't see much on the margin that's going to come in and change the calculus that's out there. Trump has indicated that he's okay going without a deal, even though it leaves the Republicans probably in a worse position in the midterms. And if that's his decision, then it's unlikely anything new would necessarily change it. So I think it's going to continue to be a long, hard slog with this, a lot of back and forth. Doesn't mean we won't get some good news here and there, just as we did in the last few minutes on Thursday, May 28th. But I think that'll be coupled with plenty of instances of bad news as well.
Okay, thanks, David. I really appreciate your thoughts on that. And as you say, pretty tricky to navigate, but we'll keep doing our best. Thanks a lot, and we'll speak to you soon.
My pleasure.
We'll move on now to Asia, where Sonal Varma, our chief economist for Asia Ex Japan, is with us. Sonal, thanks a lot for coming on this week. I think we've got the RBI ahead of us in India. What do we expect from the central bank, both in terms of this week and then maybe looking a bit further ahead through the rest of the cycle?
Yeah, Dom. So we are expecting the RBI to be on hold. I think this is in line with the consensus view, although markets are actually pricing in a 25 basis point hike. And the rationale, I think, from investor standpoint is essentially a hike either to defend the currency or a preemptive hike, to guard against inflation. Our view is RBI is unlikely to hike rates to defend currency because it is a very orthodox inflation-fighting central bank. And inflation is currently below the RBI's midpoint target. And the last experience the RBI had with hiking rates to defend the currency, this is back in 2013, it actually did not work. So what we are expecting instead is actually a hawkish hold. So we think they will revise their inflation projections up and GDP growth projections down slightly. The liquidity stance, we think, could turn slightly more hawkish from adequate to closer to neutral. We are likely to see, in our view, more measures to slow INR depreciation. Beyond this week, we do have the RBI on hold in our baseline. Yes, there are risks of a hike, but we don't see steep front-loaded hikes given India's low inflation starting point.
Yeah, I think it's interesting when you look around the world, really. We had a sort of hawkish hold, I guess, from Korea this week. We've had hawkish noises from a lot of the G10 central banks. Certainly seems that things are going in that direction. But for India particularly, you mentioned there a couple of times the currency. That's certainly something that seems to be a challenge, at least, with dollar India kind of pushing towards all-time highs, continually pushing higher. Do you think there's much the RBI can do or will do to sort of curb currency depreciation?
I think the message from policy authorities in India, I think both from the government as well as from the RBI side, does seem to suggest that there is limited appetite for further depreciation. And in terms of the policy response, I think it'll need to be a joint response from the government and the RBI together. So there are a few things they can do. So one is measures to essentially narrow the current account deficit so they can further curb some of the non-essential imports like gold, silver. They've already done parts of this, but they can tighten this further. They can restrict imports of electronics, lower the outward remittance limits for residents. So that's one. Second, there can be measures to boost capital inflows. So the big bazooka for India actually will be if they announce a diaspora bonds for non-resident Indians. The last 3 times this was done, India has raised between 1 to 1.4% of GDP, which is actually over $40 billion today. In addition, they can announce restrictions on outward direct investment because we've been seeing a lot of outflows there. The government could look at raising sovereign dollar bonds. And third is really on the macroprudential side. So they can activate bilateral swap lines, shorten the export repatriation timelines, limit hedge ratios for importers. They can open a special FX window to meet oil demand. So I think there are quite a few tools that are available. Of course, their effectiveness will also depend on how the global backdrop shapes up.
Okay, so certainly a few options on the table and a few things to watch out for there. Moving away from India, we've obviously got a lot of inflation data as well coming up this week, certainly in focus given oil pressures and everything else that we're seeing from the Middle East. What are we thinking about inflation around Asia as a whole as we go into these inflation prints?
Yeah, we do think there'll be a further pickup in headline inflation across most countries. This is data for the month of May. The main reason, of course, being higher oil prices, but there's also some food price pressures across some countries like Indonesia and Philippines. We will be watching the core numbers closely. We think for most countries it should be stable, so reflecting limited second round effects. I think the exception here is the Philippines, where headline inflation is already above 7%, and we are seeing more pass through to core. So consistent with that, we do expect the BSP to hike by 25 basis points in June and follow that up with 2 additional hikes in the second half. Korea, we think the headline inflation will rise close to 3% from 2.6%. And we did change our call for the BOK this week after the hawkish policy outcome. So we've now added 75 basis point worth of rate hikes to our profile with the first hike in July. But in Thailand, we are forecasting lower headline and softer core for May. So we do think Bank of Thailand is going to stay on hold this year.
Interesting, some sort of divergences there, particularly in terms of policy response. So hopefully some good opportunities for investors as well in terms of playing those different themes across the region. Sonal, thank you very much as always for coming on, and we'll speak to you soon.
Thanks a lot, Dom.
We're going to finish this week with Europe, where we've got George Buckley, our chief economist for the region, joining us. George, thanks as always for coming on the show. Let's start with the euro area. I think we've got CPI data and a range of PMIs coming out next week. How much of a sort of stagflationary impulse are we seeing in Europe at the moment, both in outright terms and also, I guess, in comparison to what we saw in 2022?
Yeah, well, thanks, Dom. And just to clarify, we are recording this before some of the detail, some of the country level detail, which comes out on Friday, which will go into, of course, making up the HICP numbers in Europe for May. But I think what's worth noting is that if you look at consensus forecasts and look at how they've been revised, Europe is actually one of the worst in the sense that you're seeing weaker economic growth expectations and notably stronger inflation expectations. And Europe, of course, is very highly dependent on energy. And that's one of the reasons that we've seen this worse position. There are some countries within Europe which are a bit more insulated. Spain, for example, has seen a far smaller revision on both growth and inflation than the Eurozone as a whole. But I think that's one context to look at it in. The other point to make, I think, when you're looking at these figures, which come out, as you say, on Monday next week, what's going to be important is to look at, is there any evidence at all that we're starting to see, not second round effects, because they take a lot longer to come through, but indirect effects, the way that prices, first of all, feed into energy, and then those higher energy prices are passed on because costs have gone up. So that will be really important to watch.
Thanks, George. Interesting you mentioned that, because we did get some comments from Philip Lane talking about kind of indirect and second round effects, sounding effectively quite hawkish. And if we look ahead a bit further to the ECB in June, we've got a 90% chance that they hike according to the market. I know you guys are going for both a June and a July hike, back-to-back hikes by the ECB, despite some of those negative growth associations of higher oil prices. Is there anything you're looking at this week or in the coming weeks that would make you maybe think about things differently? What could shake your conviction and maybe make you think the ECB is less likely to hike in the near term?
Well, they are probably going to say that they set rates sort of month by month. They don't want to give a running commentary of what's going to happen the following meeting. So if they do hike rates in June, which seems highly likely, then what we'll be watching for in terms of next week's data, I think, look out for the consumer expectations survey in Europe. That you can look at 1 year, 3 year, maybe 3 year and 5 year ahead inflation expectations data will be very helpful, because that will give us a real sense of whether this is morphing into a proper inflation problem or whether it's going to be constrained by weaker economic growth, which will ultimately pull inflation down and pull inflation expectations down with it. But clearly they're likely to be still pretty strong. But it's those longer term inflation expectations which will be important. As you mentioned, we get some refreshed PMI numbers next week, the purchasing managers indices. They have price indices within those. We have the Spain and Italy numbers as well. So all of those, I think anything which gives you a sense of expectations for prices. And in the UK, look out for the decision maker panel. It's one of the Bank of England's favourite surveys. The reason I mention that is because there are two measures of prices in there. One which is companies' own prices, what are they expecting to do over the next few months? And secondly, what do they think CPI inflation is going to do? So both of those could be quite important indicators over the next week.
Yeah, actually, I wanted to touch on the UK in a bit more focus there, because you kind of mentioned the DMP, which is obviously a pretty important sort of data point for the Bank of England. It's probably not as well known as many of the other big data points in some respects, but it's clearly important for the BOE. Is there anything that you would say, again, would change your conviction in terms of rate outlooks? We've got a hike in July and that's it, done and dusted for the BOE. What could potentially pull forward that hike? How high would inflation expectations, need to get maybe in the short term for the BOE to suddenly decide they needed to match the ECB and hike in June?
Yeah, I mean, I think there's a few reasons why they won't do that, just to start with. One of them is that interest rates in the UK, and this is the point you mentioned Philip Lane's speech, this is exactly what he mentioned in his interview as well, where he said that, when you come to the ECB, interest rates are neutral, so you might have to raise interest rates. When you come to the likes of maybe the Bank of England or the Federal Reserve, you could argue that interest rates are maybe a touch above neutral, in which case just not cutting interest rates might be what you need to do rather than hiking. So I think that's worth bearing in mind. But yeah, the DMP is an important survey. They mention it so many times in the Monetary Policy Report, along with the agents surveys as well. These are by far the biggest focal point for the Bank of England when it comes to survey data. And those inflation expectations, I guess one of the problems with this is that it's a wave survey, so you can't really look at 1 month compared to the other. You have to look at it in 3-month moving averages. And that, but by design, means it's a little less volatile. So I can't imagine we're going to see a big shift one way or another in that 3-month moving average. But still worth watching very closely, and just bear in mind that point about the fact that the Bank of England has interest rates which are higher relative to neutral than the ECB.
Thanks, George. Yeah, I mean, that's certainly been feeding into our view on FX, which is that the Bank of England just seems a little bit less inclined to and less likely to raise rates as aggressively, even though the market has kind of priced it quite aggressively, whereas the ECB does seem to be quite committed, at least in the next few meetings, to kind of pushing rates a little bit higher given their starting point. So we think that can still provide some backdrop for Euro outperformance, but we'll see where we go over the next week or so. George, thanks a lot for having us on, and we'll speak to you soon.
Terrific. Thanks, Dom.
Well, that's it for this week. We've covered the US, we've covered Europe, we've covered India and Asia inflation, so plenty to discuss. Thanks, as always, for listening to the podcast, which was edited and produced by John Dalton. Please do like and subscribe to Nomura's podcast using your usual podcast provider. We'd also love to hear your feedback, so please do feel free to write a review and share what you like and what you'd like to hear more of from us. We'd also appreciate it if you could share this podcast far and wide to anyone you think might be interested. You can check out nomuraconnects.com for more of our research and further updates. That's it for now. Thanks again, and good luck for the week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura. Connecting markets, East and West.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice nor is legal, regulatory, accounting, or tax advice and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.